Welcome to Blind Squirrel Macro the Pod, our usual companion to our weekly newsletter. Squirrel coming to you on the morning of Tuesday, October 15th, Melbourne time. Quick reminder to make sure you get the show notes for charts and links, and if you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. But before we start, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent, talk to a financial advisor. This week, we consider what could be the end of lithium's manic episode. Now, lithium's use as a psychiatric medication first started in the 1870s. The short-term side effects from taking it can include nausea, diarrhea, muscle weakness, or a dazed feeling. To be honest, that sounds a bit like the lived experience for the past 2 years for those poor investors in the lithium miners. Then at last, to the relief of the lithium bag holders and the picture editors of the finance media bored of decorating mining articles with the same old pictures of Caterpillar 797s, even if I do have a massive soft spot for them, it actually turns out that lithium brine ponds are incredibly photogenic, if a little bit toxic. Anyway, along comes Rio Tinto last week with a massive 90% premium all-cash bid for Arcadium Lithium down here in Australia. Boom. Does this deal mark the end of the lithium winter that investors have endured since the heady days of excitement around this theme as the ultimate picks and shovels play to the EV revolution? In March of last year, in a piece called Ben Graham's Electric Car, please look it up, it was in the pre-podcast days, I wrote that the electric vehicle investment theme fast became the preserve of stock promoters and carnival barkers. And I'm not just talking about everybody's favourite aspiring Mars colonist. The electrification of passenger vehicles is a broad topic, and I wanted to take a step back to figure out how to make money in a way that is not reliant on the greater fool theory, that is, the buying of narrative stocks. In the story category, I included pre-production lithium miners as much as car companies that do not yet sell cars. Now, this was a view that allowed the squirrel to largely stay out of trouble. The investment in Mercedes-Benz, really on a pivot to luxury theme rather than an electrification thesis, did not really work out, but leaning into lithium miners, or even the producing ones, or the broader EV battery complex would have fared significantly worse. The acquisition of Arcadium by Rio may be a small consolation prize, having failed to land that merger with Anglo American and its wealth of assets in that other green metal, copper, earlier this year. But the squirrel's whiskers had been twitching for a few weeks before the announcement. Part of the initial premise of my invitation from CNBC to come on and discuss the uranium market had been to respond by the divestment by Rio of its uranium assets in Wyoming in the US to UEC, as well as, of course, to discuss that Microsoft deal to reopen 3 Mile Island. The segment that contained my view on the Rio deal ended up on the street signs cutting room floor. But in it, I said I thought that the uranium mining sector, with its aggregate market cap of just over $60 billion, was possibly too small a sector to move the needle for a mining giant with a market cap of almost twice that amount. However, an expansion into lithium does not necessarily, at least yet, offer up a larger pool of value for Rio. The aggregate market cap of the mainly lithium miners extracted from the LIT ETF comes to only $69 billion, so only 15% than that of the listed uranium miners. But presumably off the back of the M&A whisper mill, and there are always breadcrumbs, a few weeks ago this rodent's inbox, news websites and social feeds started featuring, for the first time in a while, a lot of lithium content. Then this week, albeit post the Arcadium announcement, we find that lithium had even become a lunatic fringe issue in the US presidential election. Apparently, the recent fires in Wyoming and those floods in North Carolina are all part of a deep state conspiracy around the control of domestic lithium assets. Not to be outdone on this front, the Biden administration chose last week to cry foul on Chinese, quote, predatory pricing that was potentially undermining the efforts of the US Inflation Reduction Act to diversify energy transition supply chains. All in all, quite a lot of airtime for what is, let's face it, a fairly abundant mineral on our planet. Nevertheless, the hardcore lithium bulls certainly think that Rio has called the bottom for the battery metal. Some of Arcadium's shareholders are not satisfied at all with Rio's bid, arguing for a much higher $8 billion plus valuation for Arcadium. They see a fair value at 9 to 11 times its 2028 EBITDA of $1.3 billion, obviously discounted back to present. They cite the company's unique position with geographical diversification of assets, a vertically integrated and importantly ex-China supply chain asset, and its commercial relationships with major auto and battery OEMs. To be honest, on that last bit, I've always been a little bit dubious about auto OEM deals with miners. They have a whiff of ESG smoke and mirror about them. Indeed, the research team at Citi reckons it would cost more than $7.7 billion to recreate Arcadium's portfolio of assets, technology, expertise, and growth options from scratch. However, given that there does not appear to be a competing bidder for Arcadium alongside Rio, not a company, let's be fair, that's known for being a black belt in M&A markets, it strikes a squirrel that those holdout shareholders might potentially be a tiny bit out over their skis. Rio's $5.85 per share bid values Arcadium at $6.7 billion US. The miner's management team hopes to double revenue by 2028 and grow EBITDA to $1.3 billion from $525 million in 2025. Now that's a 34% CAGR, with plenty of execution risk, I might add. Rio's bid for Arcadium also looks to be at a healthy premium to the median of the EBITDA positive lithium mining comps. That promised $1.3 billion of Arcadium EBITDA in 2028 is still 4 to 5 years away and is also predicated on a lithium price 85% higher than current spot. As of Friday's close, Arcadium is sitting at a 5% discount to Rio's cash bid price, a fair financing spread for a transaction that's not expected to close until the middle of next year and which is subject to multiple international regulatory approvals. So the squirrel's message to the Arcadium minorities would be pretty clear. Take Rio's cash and run, Forrest, run. However, does Rio's strategic move mean that we should be hunting elsewhere in the sector? Rio's acquisition slide deck forecasts a market that moves into deficit by the end of this decade, and they clearly think that they're catching the bottom of a multi-decade bull cycle. Right product, right time, goes the tagline of the presentation. Let's take a step back. Notwithstanding its importance to the energy transition, the absolute size of the lithium market is still pretty small relative to other industrial and technology metals. Lithium's white gold nickname is frankly a bit of a stretch. The Earth's crust is estimated to have over 89 million metric tons of lithium, even if only 25% of that is considered economically viable to mine. It should also be noted that BHP, Rio's metals giant competitor, is on record as considering that lithium's abundance is a negative. They ain't chasing. BHP's CEO has also voiced his concerns about the flatness of lithium's cost curve, with the resilience of the best assets being not sufficiently superior to the more marginal plays. However, the IEA thinks that we're going to need plenty of the white stuff, whatever you may think about that particular organization's forecasting track record. In the scenario consistent with their SDS Sustainable Development Goals, annual lithium demand reaches 1.16 million metric tons by 2040. However, this assumes that EV adoption and energy storage use cases account for about 90% of that volume. Now, the squirrel has covered the thorny topic of slowing EV penetration rates and the rapidly increasing consumer preference for hybrid powertrains in previous podcasts. I'm not going to re-rehearse the arguments here, but we are long platinum and palladium in the portfolio chiefly for this reason. Hybrids use a lot of that stuff. Not brave enough, I'm afraid, for those sketchy PGM miners yet. I do believe that hybrid adoption for passenger cars will surprise to the upside for the balance of this decade. With this in mind, we do need to consider the potential impact of competing battery technologies when thinking about lithium's role beyond that time frame. While lithium-ion batteries dominate today's markets, alternatives like sodium, zinc, and iron-based solutions are advancing rapidly. Sodium-ion batteries are cheaper but have a lower energy density. Zinc-air batteries offer higher energy density and improved safety but face limitations in power output. Iron-based battery solutions would appear to be the most promising, but really just for static storage solutions. In any event, lithium technology continues to evolve and get better. A wholesale switch away from the metal is unlikely in the near term, and lithium supply-demand imbalance in the next 3 to 5 years is key to the investment case for lithium miners if you're looking at them right now. The battering of spot lithium markets and their miners in the past 18 months has largely been attributed to the upside supply surprises from Africa, and to aggressive production by Chinese players, which the analyst Marin Katusa calls a cut-to-kill strategy, which reminds him of Kazakhstan's historical attempts to kill off the junior uranium miners. Arcane Capital's YJ Lee argues forcefully that the market has bottomed. He feels that the recent downgrades of lithium demand by the market fail to appreciate the growth of electrification trends in renewable storage, commercial vehicle and mass transit applications. He also feels that industry estimates on the supply side of the equation have failed to take into account the impact of planned production cuts by the principal Chinese players. YJ has built a compelling bottom-up analysis of supply and thinks the lithium market deficits could be a reality in the next 12 months. A deficit which, I quote, could last for the next few years and would see prices back at $30,000 per metric ton by 2028, i.e. 3 times higher than current spot. I've grabbed a couple of his charts for the show notes. Please have a look. Minor digression, but for the silver bulls amongst you, YJ also paints a compelling and quantitative picture for industrial demand, principally from solar, for the other white metal emerging in the coming years, a view echoed by a number of other analysts that I rate in recent weeks. But back to lithium. What worries me about YJ's take on supply curtailment is what happens to the assets currently in care and maintenance as soon as lithium spot prices recover back above those flat production cost curves. It strikes me that much of the attraction for the industry relies on the politics of supply chain security. The process of reshoring, nearshoring, friendshoring, call it what you will, driven by populist policies in the West, appears to lie at the core of the arguments of some of the more vocal promotional voices in the lithium mining value chain. The squirrel worries that lithium supply chain duplication or diversification becomes a fragile bedrock for a new bull market if a new resident at the White House next month decides that a beautiful shiny deal with China is preferable to yet another source of inflationary pressure. However, it is important to remind ourselves never to go full geo-macro, and there may well be an interesting trade in lithium in the near term. In section 2 of the written note this week, we look at some of the alternatives. You may need some lithium pills to calm your white gold miner mania. Well, maybe. Please check that out and get more inquiring rodent at blindsquirrelmacro.com or find me on Twitter @squirrelmacro. Thanks again for listening. Squirrel out.